Yeah, it's great to have you with us on this Friday morning. And while it is technically a sleepy time on the calendar for the markets, there's nothing quiet about the action we've been seeing this morning. Notable weakness in the pre-market with less than 30 minutes to go before the opening bells. August trading kicked off yesterday with a thud. Investors shifting their view from being bullish on the idea of interest rate cuts coming soon in the U.S. to being fearful that the Fed waited too long and the economic challenges are now mounting. That left a lot of traders waiting for the latest American jobs report this morning, and the consensus on that seems to be, well, maybe the Fed is behind the curve here because we saw some deterioration in the jobs market. Now, the other factor we were watching in the markets right now is troubles for tech stocks. They have arguably been easy targets of late because they enjoyed such a big run-up, and investors have more often than not been finding reasons to sell based on what they've been hearing during earnings season. Let's take the example of Amazon. Well, the company once again flexed its sales muscle in last night's results. There are concerns around bottom line performance, specifically Amazon's costs. Are they rising too quickly as it looks to meet demand for AI services? You'll recall earlier this week, Meta scored some points with investors for managing the AI spending message by implying that spending is already benefiting its ad business. But last week, Alphabet, the parent of Google, was basically scolded by the market for overall its AI spending bill. Now, with its earnings, Apple, another big tech player that reported after the bell last night, tried to paint a picture of AI growth, essentially saying its new AI features will spur iPhone growth. Whether that's enough to offset broader worries about consumer spending and demand in China remains to be seen. At this hour, Apple's a little weaker in the pre-market. And finally, we can't ignore this story around Intel, which is headed for its biggest one-day stock decline in 24 years after offering up a grim forecast and laying out plans to cut 15,000 jobs. A fairly clear sign the one-time dominant chip name is having a tough time competing with today's AI darlings, NVIDIA and AMD. And note, Intel is a Dow component, so that's a factor to watch in today's Dow performance. Let's also talk about the situation for the Canadian stock market. We mentioned it was roughed up yesterday to start August trading. That comes after an impressive July. The TSX was one of the world's best performing markets during the month. In fact, it had its best outperformance versus the S&P 500 since September 2022. Now, for those curious about whether the rally can continue, obviously this morning it's a bit dicey out there. But if there is investor interest in non-tech names, certainly that is the kind of makeup that rules the Canadian market, so we'll see how that plays out in terms of the sector rotation. We are now in earnings season. It is worth assessing the profit picture as well, and even though there are uncertainties for the Canadian economy, TSX-listed companies are on track for their first quarter of year-over-year earnings growth since the third quarter of 2022. Analysts have revised some of their targets lower recently, including for some of the energy names, so I guess we'll see how that plays out as well. Joining us to make sense of all of this news is Laura Lau. She's Chief Investment Officer at Brompton Group. Great to see you, Laura.
Thanks for having me here, John.
There's a lot of moving parts, but I do want to start with this fresh story out of the United States. We've very quickly gone from a market that was embracing the idea of rate cuts to now being concerned that the Fed is behind the curve and ultimately, the economic backdrop is looking much weaker, and that should be a concern to investors. Where do you stand on that?
So I think we've been spoiled. We've been in a kind of a Goldilocks scenario for the United States where unemployment was very low, historical numbers. Inflation was a little too high, but you know that now that's coming down. So it was a very Goldilocks scenario. So unfortunately, anything from there is probably down.
Yeah.
And we didn't have the big down, so we're probably not going to have a big up. So I can see that investors are probably concerned, especially since, you know, the market is not cheap. But if you do look at things like return on equity and adjust for that, it's not as expensive as people think. And the AI story, I think that companies have to do a better job of messaging. What I mean by that is Meta, we're spending. Oh, we're spending, but we're actually getting a return on our investment. So I think you need two things. You need to give them more visibility on your capital spending, and that's difficult because the truth is they don't know.
Yeah.
It's really, right now it's like, can I get more chips from Jensen Huang at NVIDIA? Right. That's really the answer. If I can get those chips, I'll spend the capital.
Yeah.
But what are you going to do with that capital? How are you going to make a return from it? So I think that Meta has, changed that messaging, and I think all the other big tech firms have to do a better job of saying how we're going to make money from this.
And then if you're an investor and you're listening to whatever the message is, successful or not from technology companies, and then you're looking at the data that we're seeing right now, I mean, let's call this what it is. It is a market on edge this morning. But to your earlier point, pullbacks have been rare, especially for the S&P 500. We had seen a pullback off the summer highs, but we didn't even quite get to 5%. And I mean, for something to technically classify as a pullback, it's got to be 5 or 10%. Corrections are more than 10%. So we have not had a lot of lags during this run-up. So is that worth consideration in this Friday and weakness following the Thursday weakness we saw?
Definitely. So
Okay.
we still think we're in a bull market, and 5 to 10% corrections are actually very normal and healthy. The market has been almost going straight up, and it's time to take a pause and digest all the information and see what the data comes in. I do think that, the market is pricing in 75 to 100 basis point cuts in the Fed, and it's funny because coming in the year it was 150 basis
Yeah,
points,
exactly.
and then
Exactly.
it was down to 1, and now it's back to 100. So the market's flip-flopping, and one thing to remember is the more cuts are actually bad. It means the economy is not doing well.
Right.
But the last GDP print was good, but it is a lagging indicator. So I do think that the United States, the economy is probably holding in, but we're starting to see those cracks.
Okay, well, it's feeling like an adjustment period here for the market to reassess what's going on. But then we've got the story of the Canadian stock market, which, it's if the U.S. has a sneeze, we're gonna feel it, right? So we saw some weakness yesterday for the Canadian stock market. It was the worst day of performance in months, but it was coming after this record run for the Canadian stock market. We've had so many pundits come on the program, and they've talked about this rotation away from tech and into some of the sectors that are part of the fabric of the Canadian stock market. How do you feel about the Canadian stock market's prospects versus the U.S. right now?
So I still think, as you said, if the U.S. doesn't do well, then Canada does worse. And we are very predicated on global growth. One thing that does help us is the golds. We do have a lot of golds in Canada. So that does help offset that.
And you're not hearing a lot of people who are saying we're bearish on gold right now. It's kind of the bullion's moment, it almost feels like.
Yeah, so we have a lot of energy. Natural gas is on its knees. LNG Canada will come on. We are going to have liquefied natural gas plants coming on in the U.S., so that'll help natural gas. And in terms of oil, it's more about OPEC+. OPEC+ has signaled October they're going to probably bring barrels back on the market. So I think we're kind of range bound there in terms of oil.
And before we wrap things up, like for broader sector or portfolio positioning or strategy right now, kind of what's your roadmap, Laura? Like what would you be doing with one's money right now?
I think that we're kind of in a barbell strategy. What I mean by that is we still believe tech will do well. We still believe that's where the growth is. But you should probably position yourself in some of those cheaper tech stocks. Like I do think Apple has a refresh cycle coming. I do think Meta and Google, the messaging should improve, and then maybe some of those interest sensitives that will benefit from interest rates coming down, like utilities.
But you wouldn't be exiting the stock market. Like you still think there's a benefit of being invested in equities right now.
Yes, it's hard to predict when the stock market will sell off or when it'll rally. So I do think you should stay invested.